In my debate with what's his name, Steve Beeman. In my debate with Steve about taxes as a fiscal stimulus, I missed and a tip of the hat to David Weinstein, CPA, who's in our chat room right now, and posted this, and it just like completely reminded me. If you want to see businesses in the United States invest in the United States, if you want to see them invest in R&D, if you want to see them building new factories and buying new equipment and developing new products to try to open new markets and come up with new stuff, raise taxes, business taxes. Now people say, well, wait a minute, what are you talking about here? Raise taxes to get healthier business activity in the United States? Yes. Here's how it works. Let's say that you're a company that makes, in fact, I could, I was going to use one of my own companies as an example, but it's probably a bad example. So let's say you're a company, let's make it generic. You own a company or you run a company that makes widgets, right? You got 100 employees, you got a, $10 million a year budget, and you make widgets. And the corporate tax rate is 35%. And you make $1 million in profits, so you're gonna have to pay $350,000 in taxes. If you invest that $1 million, or let's say half that million, well, let's just say you want to take your tax rate down to 0. All you have to do is take that $1 million and put it into tax-deductible things like research and development, new product development, advertising and marketing, hiring staff, building factories, developing new products. These are all tax-deductible business expenses. So, if the tax rate is 35% or if the tax rate is 50%, you can get your taxes lower and lower and lower. In fact, the higher the tax rate is, the stronger the incentive that you have as a business person is to invest in your business, to grow your business, rather than simply suck the money out as dividends, because dividends are after-tax income. So you have to pay a tax. You declare the profit, then you pay a tax on the profit, and then you take the profit that's left over and either roll it into future years or you distribute it to your stockholders as dividends, or what most companies do is a little bit of both. But that's after taxes. So you want to reduce your taxes. Now, what happens if you cut the tax rate? If you cut the tax rate from 35%, where it is right now, let's say down to 15%, like Donald Trump is proposing, a lot of companies are going to look at that and go, okay, we got $1 million profit here. We're going to have to pay $150,000 in taxes, 15%. And then we can just take the $700 or the $850,000 that's left over, and we can split it up among us as dividends and just pay ourselves. The cost is only 15% to be able to take all this money out of our company. So let's just do that. See, right now it's fairly expensive to do that. So, I mean, this is just, I realize it's not the, I can't turn this into a bumper. Well, maybe I can turn it into a bumper sticker. Here, it's a very simple equation. What corporate income taxes do is they incentivize investment. And what reducing corporate taxes does is incentivizes stripping money out of companies and putting it into the pockets of stockholders and the stockholders who are the typically the senior management. It's very simple. Lower corporate taxes, more money for the billionaires. Higher corporate taxes, more investment in the business. I mean, it's not unlike you and me. I mean, just normal people. If you're going to pay taxes at the end of the year, but you got to live someplace, right? So you have a choice. You can rent or you can buy. If you buy, you could buy with cash or you can get a mortgage. Most people can't afford to buy with cash, so they get a mortgage. But the reason why most people get a mortgage, and frankly, At least 2/3 of all the wealth that Louise and I have right now, in our retirement fund, is simply the result of having bought a house back in the late 70s, and then sold it and bought another house and sold it and bought another house. And every step along the way, you're just building more and more equity in your houses until you've got a nicer and nicer house. And ultimately, you can sell that, and you've got some money that you can put in the bank and say, this is my retirement, which is basically largely what we did. I mean, our businesses, we've made a lot of money with our businesses, but we've taken a lot of years off, too, and spent that money. So our equity has been, this is how most Americans build equity. So, if you had no income taxes, you'd have no incentive to buy a house with a mortgage, because that's a tax-deductible expense, right? The mortgage expense comes off your taxes. Rent does not come off your taxes. And this was done very intentionally back in the 30s or 40s. This law was passed to make mortgage income tax deductible. And by the way, back then, credit card, all interest was tax deductible. Right? It was to encourage people to go into debt to stimulate the economy. And some kinds of debt are healthy debt and stimulative, like mortgage debt. And some kinds of debt are unhealthy debt and stimulative, like credit card debt. And so we stopped making credit card debt tax deductible, which I think is actually a wise policy, because no longer are you encouraging people to put money, to run up debt on their credit card. They're doing it because Reaganomics has just devastated, the working people of this country, and you pretty much have to. But it's the same thing. If there was no income tax to pay, then why pay a mortgage? Why buy a house? Why not just rent? And then, of course, that kind of changes the housing market, but it also changes the way that families build equity, over the course of their lifetimes. So there's a strong argument to be made for actually closing a lot of the loopholes in the corporate tax code, because the effective corporate tax rate in the United States right now is actually around 16 or 17%. That's what the companies that actually pay income taxes are paying, because there's so many ways to get around it. And you can call them loopholes. I mean, depreciation, like things like that. But some of them, like, R&D, I would say those are good loopholes.
This is the Thom Hartmann Program.
Now, 3 martini lunches, not necessarily so good, but R&D, definitely good.